What's up everyone, it's Scotty with MoneyVest. So in this video we are going to be talking about Walgreens Boots Alliance, ticker symbol WBA, and it did rally quite a bit on Friday, up a little bit over 6% after the news came out that a new potential CEO, ex-Cigna Group and CVS Health Benefits Group manager, Tim, and that's going to be Tim Wentworth, is going to be a potential replacement for Ross Brewer in Walgreens. Of course, nothing's been finalized yet, but that was one of the reasons why the stock was up significantly, up a little bit over 6%. I'm going to break down that catalyst, and we're going to run over some fundamentals for this company. We've already done a couple videos on Walgreens. I've talked about the fundamental analysis. We've done some comparisons between Walgreens and CVS and UNH and how their businesses kind of differ. But of course, Walgreens has been a big underperformer in 2023. In fact, all healthcare providers and biotech has been underperforming, and a lot of retail has been underperforming in 2023 as well. So Walgreens is not alone, but yes, it has performed worse than a lot of these other companies because of everything that's been going around the business with respect to having little to no guidance as to where we're going, margin compression, profitability kind of stagnating a little bit, and of course a lot of cash burn with acquisitions, and of course COVID vaccines coming to a more normalized level, and we are seeing that decline on a year-over-year basis. So we're going to discuss all of that. Hope you guys enjoyed this video, find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buying alerts, options alerts, trade ideas, market update videos, members only private videos. Everything is going to be included. And again, there are 2 more days left. In fact, actually today, literally September 30th, is the last day if you want to take advantage of that 16% annual discount that's available for our members, for Patreon members. So again, link's going to be down below if you're interested in joining us and getting access to all those benefits. So Walgreens eyes Tim Wentworth, ex-Cigna executive, for CEO. So Walgreens is considering the former Cigna Group executive Tim Wentworth to be its next chief executive officer, and a final decision hasn't been made, and Wentworth may not wind up in the job, said the people who are familiar with the matter. And this right here is a very quick profile on who he is and what he does. So he's basically American businessman. He's a former CEO of Evernorth and Cigna's health services platform, and former CEO of Express Scripts, the United States' largest pharmacy benefits manager as well. Now, one of the things about Walgreens is that their revenue has almost always come from retail and physical stores and pharmacy, right? That's been their main sort of core competency. Is Walgreens is a pharmacy, right? Retail and pharmacy has been the main driver for revenue. Now, the problem with that obviously is that there is a lot of competition and the margins are not that high as opposed to some of the other companies that may offer benefits, right? And that's where CVS kind of separates itself. And again, we've talked about all these things in our previous videos as well, but if you come over to CVS, you'll notice that the margins here for the company are going to be a little bit over 2.7, 2.3% on a net basis, but their revenue breakdown, right? That's going to be the pharmacy sales, 169 billion. Retail is going to be 106 billion, but we also got the healthcare benefits section, which is about 91, 92 billion dollars. That's a pretty sizable number, and that's where the margins come in, right? There's basically the insurance products is really where the margins are, because if you are able to provide insurance policies to people, then obviously the premiums, and you can use that premiums to invest more money in debt securities, generate more income. So that is something that Walgreens, in my opinion, does lack pretty significantly, but they have taken a different route in building, healthcare solution for people, so kind of partnering with Village MD, creating these different, doctor appointments, and of course having healthcare professionals in those offices to kind of help people. But that also is very expensive, right? It requires a lot of cash, and for that reason, of course, we have seen, if you come over to the cash flow statement, the free cash flow has obviously not done really well. If anything, it's declined over the years because CapEx has been going higher. So, if you come over to capital expenditures, so purchase of this right here, capital expenditures, it has been increasing every single year. So this right here has been a little bit over 1.3, then this year 1.7 and $1.7 billion in 2022. So it's obviously been very, very expensive for Walgreens to continue its operations. I believe CVS is also at almost an identical level, or maybe a little bit more in terms of their CapEx. But the interesting thing is that their revenue is substantially more than that of Walgreens, right? So if you come over to investing activities for CVS, we're looking at, look at that. So CapEx is actually at 2.7 billion, right? So they're spending 2.7 billion with the revenues of $322 billion versus Walgreens that is spending 1.7 billion and revenues are at around 132 billion, right? That's night and day. Like that pretty much tells you return on invested capital is substantially better for CVS than it is for Walgreens. And if you come over to the weekly chart, of course, we have just been aggressively selling off. Literally since 2015, the stock is down a little bit over 70%, and of course since the 2018 sell-off from back in $71, it is down a little bit over 69, close to 70%. Now the dividend yield has jumped up to over 8.6%. So one of the things that Walgreens obviously is known for is being a dividend aristocrat. They have been consistently paying out dividends over the years, and they have been increasing that dividend as well, but which I believe is about 3 to 4% compounded annual growth over the year. And the payout ratio right now, of course, it shows negative, but if you come over to the statistics, actually the dividends, you'll notice the payout ratio has been a little bit consistent at around 38%. This right here, 41%. Obviously, it did jump up to pretty high levels in 2020, but it's been around 38 to 40%. Even in the past, you'll notice 2016, 2017, 2018, around 35 to 40%. Now, dividend, as I mentioned before, could come under pressure if the company starts looking at some cost-cutting measures because the balance sheet is not the best. If you come over to the balance sheet here, you'll notice that the company does have a very significant net debt of about $36 billion as of the third quarter 23, and they don't have a lot of cash with respect to the total amount of debt the company's sitting on. And of course, assets also are a lot less than the total liabilities. If you come over to the actual quick ratio, 0.32, current ratio at 0.63. So short-term liquidity certainly is a bit of a concern for the company. And we've got the debt to asset ratio around 0.38 as well. So again, these are some of the metrics that, yes, they are a little bit concerning. And we have seen, again, the earnings expectations have also been slightly flat. So it's not really a growing company, so it's not expected to grow or go anywhere in terms of that earnings per share. Pretty much at $4 all the way up to as much as $4.50 maybe by 2026, and that's not a lot of growth. So dividend, when it comes to dividend yield at 8.6%, it's kind of a tough call because if the company and the board and the management decides that they want to cut some cost and save some money, there is possibility that they may cut the dividend. But I also doubt that because they kind of have that label of being a dividend aristocrat, and for that reason, it is somewhat unlikely that they cut the dividend, but it's not impossible, right? We've heard from a lot of companies. I mean, Intel ended up cutting the dividend, right? Who would have thought that Intel would cut the dividend? So if Walgreens ends up cutting the dividend, which obviously is a possibility, like I said, is going to be a big blow for a lot of dividend investors because Walgreens is known and kind of seen as a dividend stock, yielding over 8.6%. But nonetheless, we are very, very oversold right now, right? From a technical perspective, the RSI, the MACD, very oversold. And right now we're sitting right around $20 per share, which also is my intrinsic value that we've calculated in our previous videos. And right now we're seeing a very nice move back up to the upside on that news. Now, this right here are some of the other accomplishments for Tim Wentworth that I wanted to go over. So CEO of Evernorth, Cigna's health services platform, 2021-2022. CEO of Express Scripts, the United States' largest pharmacy benefit manager. Now, I do believe that if Walgreens actually starts an insurance offering, I think that might actually turn things around. It might be a higher margin, higher profitability business for the company, something that very similar to CVS or UNH that have been doing it, instead of kind of spending a lot of money on partnering with other companies, like doing these acquisitions with VillageMD and whatnot, and building a lot of these offices, a lot of these doctor offices. I think it'll be better if they actually start offering some pharmacy benefits and health benefits and, of course, insurance policies. I think that would be more profitable and something that, can turn the company around from a fundamental basis. Executive Vice President and President of CVS Health Specialty Pharmacy Business. So he's also worked at CVS, CVS Health Retail Pharmacy, CVS Health Pharmacy Services, and named 50 most influential people in healthcare by Modern Healthcare in 2017 as well. Now, it was interesting, Roz Brewer obviously came from a retail side of things, but didn't quite have the understanding, in my opinion, at least, of the healthcare side, because obviously she worked at Starbucks prior to Walgreens, but Tim Wentworth would actually be a good fit because Walgreens is, at the end of the day, a pharmacy and retail sales business, and they do have an element of that healthcare side, which needs to be taken advantage of. There's a lot of untapped potential in that space, which, again, there's going to be a lot of potential ideas for Tim Wentworth, and that's really where the guidance is going to come from. So, that's where we are. I think dividends is going to be very, very important to watch for Walgreens because right now the stock is still very much a dividend aristocrat. Lots of dividend investors are very much excited about Walgreens paying out 8%, 9% dividends. Right now, it's not a growth stock by any means, and the valuation obviously is going to be very, very low. So if you come over to statistics, we're trading at price to sales at under 0.14, cash flow under 14. There's no price to earnings because earnings expectations are negative right now. And of course, price to enterprise value to EBITDA under 15, right? So valuations are quite low, so it's not really a growth stock. It's mostly a dividend stock, but I wouldn't be surprised to see a little bit of that momentum back higher considering how oversold we really are from a technical standpoint for Walgreens. So let me know in the comment section down below, what do you think about this stock and what are your thoughts on this new potential CEO that we may or may not have? Link's going to be down below for our Discord, for our Patreon. We'd love to have you on board. There is a 16% annual discount that's available till the end of this month. So literally tonight it does expire. I have opened up a couple more spots for you guys. And as always, happy investing. I'll see you all in the next video.